Here is a Forex trade that I took recently with over $1,247 in the profit, and here is another Forex trade with $1,165 trading setup that followed the same trading logic. And the best part is that I used just two indicators to time both entries perfectly. Now, although the indicators can't help, but you have to realize that I have been trading Forex for many years and I have lost a lot of money before I get to this point of being profitable in the Forex. So today, by the end of this video, you will understand how I use these two indicators step by step so you can spot high probability trades in the Forex market, and maybe I can bring you one step closer to achieving profits like myself. Okay guys, so before we even touch the trading indicators, you need to understand why do they work in the first place, because well, indicators by themselves, they don't move the Forex market. Price action, market structure, and liquidity do. So that's why I always love to start with the bigger picture, which means supply and demand zones, and identifying whether the price is making higher highs or lower lows. Now, supply and demand shows where money enters and exits the Forex market, because that's where big institutions stack their orders, and that's where the most profitable trades begin. So the first thing I do is I mark my zones on the 4-hour chart, and I'm looking for an area where the price reacted strongly before, leaving imbalances or rejection wicks. But if I'm scalping the market, then I would still use the same logic, just refined on the lower time frames. So once I have those price levels, I then look at the overall market structure, and this is not only for the entry time frame but the higher time frames as well, which means that is the market forming higher highs and higher lows, or lower highs and lower lows? And that's usually enough for me to know whether the Forex market is trending up, trending down, or just simply reversing. So once I know the market direction and I have marked my high probability zones, that's when my two trading indicators come in handy. So the first indicator that I use is the Fibonacci retracement, which simply helps me to measure something called equilibrium, which is the fair value price where the market likes to pull back before continuing the overall market trend. Now, I mainly focus in between the 50 and 61.8% levels, because that's where the price tends to react before the next impulse move. And the second indicator that I use is the weekly pivot points, and I'm using them to confirm whether that pullback aligns with the institutional support or resistance zones. So when both the Fibonacci level and the weekly pivot point line up inside a valid supply or demand zone, that's where I look to enter my trades with full confidence in this trading setup. Okay guys, so now let me show you one of my real trades that I took recently with my trading group members, and this is AUD Swiss. So first, the overall market trend was bearish. We can clearly see that if we start from the monthly time frame, as you can see, trending down. If we go down to the weekly, beautiful bearish trend over here, and also if we are on the daily time frame, the overall market trend is also heavily bearish. So now that I know the overall market trend, I then start to look for a supply level to trade from. Now typically I try to find these on the 4-hour time frame, but this time I got lucky and I spotted a very clean supply zone on the daily chart, which is even better. So in this case, the supply level was just like that, and of course supply, it's red, so we're gonna make it like this. So once I mark that supply zone on the daily chart, I then move back down to the 4-hour time frame to find exactly where to enter the trade, and this is where the two indicators become very important. So first, the weekly pivot point was found on the 4-hour time frame, which is this red line. I'm gonna mark it just like that so it's better to see, and in this case it was sitting just above our entry, giving us a safe entry point. Now, since when this supply zone originated from the daily chart, I also used the daily Fibonacci to measure the equilibrium level that we discussed earlier on. So for this particular trade, the equilibrium level looked like this, and as you can see, in this case the price was just between the 618 and 0.5 Fibonacci levels. Now for the take profit, the logical target levels were the previous demand zones. So there was one here around the middle of the move and another one just above our hour full take profit, and there was another one visible on a higher time frame. And actually all of these zones could serve you as a partial profit taking points, of course depending on how you wish to manage your money when trading the Forex market. Now when it comes to the stop loss, I just simply took the ATR value from the 4-hour chart and I doubled it. So at that moment the ATR was around 30 pips or roughly 0.57% of the trade, and as you can see it's giving us a substantial 5.33 risk to reward ratio. And now let's see how this trade actually played out. As you can see, absolutely beautiful. It finally hit the profit target of 160 pips, and as you can see it continued dropping down. And here is the actual trade outcome I shared in my free Telegram trading group, and as you can see the candlestick covers half of the screen, which I think is a perfect sniper entry for the trade. Okay, so with this strategy there's one big mistake that many Forex traders make, and you need to avoid it like a plague, and it's something called zone freshness. Unfortunately, if you get this part wrong, these two powerful indicators suddenly stop working as well, and this is just the harsh reality if you mess up the foundation of your Forex trading strategy. So let me quickly show you exactly what I mean. So this is AUD/USD, and we can see a very clean supply zone, right? Because we have a bullish candlestick, consolidation, and then a sharp institutional bearish move towards the downside. And at first glance this looks great because as you can see, when the market retested this exact price zone, it reacted strongly again, giving a profitable trade, right? But the problem is that after the first touch, the supply zone becomes at least 10 times weaker, meaning it might not hold up on the next attempt. And this could actually get even riskier if you are trading on the 4-hour chart, and it's even worse if you are day trading or scalping the lower time frames. So let's take a closer look, and as you can see, the market touched the zone once again, initially with this small wick. And technically that signals a sell, but notice what happens next. The following candlestick pushed even deeper into the zone. And at first this isn't necessarily bad. In fact, you might even get a better entry price for your trade. But remember, because the zone wasn't fresh anymore, the price completely ignored the only two indicators, which is the weekly pivot point and equilibrium, and as you can see it pushed straight through, turning a potentially profitable setup into a losing one. So the moral of the story is to never trade a zone that's already been touched. Instead, only trade fresh zones, the ones that smell like a newly printed money. So to wrap it all up, make sure you mark your supply and demand zones, you confirm the market direction, measure fair value price with the Fibonacci level, and check the weekly pivot point for trade confirmation. And that's how I use just two indicators to consistently trade the Forex market with the full confidence. And if you found this helpful, make sure you grab my free trading journal or join my VP trading group. You'll find all the links in my description box down below. And of course, make sure you watch this video next if you want to learn more about trading Forex.